What are the sources of economies of scale? There are a few types of those sources. First of all, some economies of scale come from technological reasons. What is that? These are like specialization and labor division, for instance. If your business is bigger, then you are likely to employ some specialists. If you run a very small business, you can be both the owner and the salesperson, and you may help producing things. When your business is bigger, you employ people. Some people are particularly good at selling things, for instance. They would be better than you as the owner. Some people are very good at production, organizing production, or quality check, or whatever, right? So specialization. For a big business, it is possible to use specialists for each and every part of their operation. The second thing stemming from technological sources of economies of scale is the characteristics of some production factors. Some of them are non-divisible, meaning they come in such big portions that actually using them for a small scale is inefficient. Think of a combine harvester, for instance. If you have a farm and it's like 10 hectares, then actually there is no use buying such an expensive piece of equipment like combine harvester because your farm is simply too small, right, to be operated with the use of such thing, right? So it's better, for instance, if you rent it out. Or you may think of a foundry, right? When you look at foundries, they are always big. I mean, you cannot see any foundry that would produce 100 kilograms of steel per day. Okay? These are tons, these are hundreds of tons or even thousands of tons of production, because foundries must be big to be efficient. So this is about non-divisibility of production factor. Then multi-stage production. You can see it also under the name of vertical integration. This is a technological source of economies of scale, clearly visible in oil industry. So we've got some companies that drill and look for oil. They take this oil out. They build pipelines or they operate tankers to send this oil to refineries, which they own. So they process the oil. They get several products out of that, like oils, engine oils, like fuel, car fuel, other stuff, right? And they, for instance, sell those car engine oils and fuel using their own network of petrol stations. So you can see one company operating many stages of production, right? So this is what you can see, and that is a source of economies of scale. It's good when you are big to do that. Then you can try to use your wastes as a side product. So sometimes it is that you run a sawmill, for instance, to cut trees or cut wood into pieces like boards and this kind of stuff. And you can use the waste to create, for instance, pellet, those small things that could be It could be burned in some furnace to get heating, right? So this is using waste for side production, right? So you actually do not take any cost of utilizing waste, but you convert your wastes into something that still may be useful for other people, for customers. You can sell it at a certain value. But for this to be possible, to make it possible to use your waste for side production, you obviously need to have a nice big scale of your operations. Another source, still stemming from technology itself, is R&D activity, research and development. And remember, this research and development activity that helps to develop new products, find new products, create them, make innovations, radical innovations, not incremental ones, but radical ones. This is all very typical for big businesses. This is not the domain of small business, right? They do not have enough manpower, enough of resources, enough of financial capital, and so on and so forth. Research and development, really huge divisions that do research and development activities. Well, that's domain of large businesses. You need to be large for that. And the last thing is the so-called container rule, which is explained here in this slide. It basically can be explained with the example of a plain container that is a cubic figure. Imagine that you use it to store your production, for instance, right? It's made of steel, 1 meter by 1 meter by 1 meter, 1 cubic meter of volume, right? And if you look at how much steel you need to make such a container, well, a cube has 6 walls, so this is 1 meter by 1 meter, 6 square meters. This is how much steel you need, and this is the cost, right? So you pay for 6 square meters of steel to be able to store 1 cubic meter of your goods. Let's use another scale, economies of scale, right? So let's say we will make containers that are bigger, like 3 times bigger, in the sense that instead of 1 meter long, they would be 3 meters long. So that would be 3 by 3 by 3. Okay. So one wall would be now 3 by 3, which is 9. We've got 6 such walls, so that's 9 square meters times 6. That's 54 square meters. Right? You can clearly see that this is 9 times more than previously. So the cost of making this bigger container is 9 times bigger than for the small one. You could have 9 small ones for this one big. But if you look at the volume of this big container, it can hold as much as 27 cubic meters of your product. So it is 9 times more expensive, but it is 27 times bigger. So as you can see, keeping your goods in this bigger container is actually 3 times cheaper. And this is yet another economy of scale. Marketing sources of economies of scale dwell on 4 factors, actually. The first one being wholesale purchase. When you are bigger, then you become more and more important partner for your suppliers. If you are small and the scale of your operation does not really influence their businesses, then your negotiating position is pretty low. The more you grow your production, the bigger you grow, the more important customer you become. So you can negotiate more, like better terms, some discounts, or you can enlarge the payment period, right? So you can pay later for the supplies. There are many possibilities here, right? It's better to talk with your suppliers when you are big. The second factor is the cost of packaging and transportation. Those costs grow more slowly than your production. It is kind of based on the same idea that the rule of container, right? So sometimes sending your product somewhere, even if you, for instance, double the delivery, I mean, you send twice as much as previously, but it still can be done with one car, not two cars, right? So this is, for instance, possible that if you send more, actually the cost of transportation or the cost of packaging doesn't grow as quickly as your production. The third factor is actually based on something that we already mentioned: specialization and labor division. Specialization in sales, specialization in purchase activities, right? Those two specializations would play important role for marketing sources of economies of scale. And the last one but a very important one actually, these are advertising costs. You know, advertising nowadays is very important. And the costs of an advertising campaign are usually quite high. They would belong to the concept of fixed cost, in fact, because the cost of advertising, they do not depend on quantity produced. And therefore, if you are big, those advertising costs would be dispersed over many items of your production. If you are small, those advertising costs would be big per one product, therefore the increase in the cost of production would be pretty high. That's why small businesses rarely go into advertising campaigns. And well, even if they do, they are local, focused on some selected markets or selected customers, right? Those big advertisement campaigns are kind of limited to those big players. So we need to be big to advertise on a bigger scale. Financial sources of economies of scale would be based on three factors. First of all, for many businesses, the most obvious source of financing are banks and bank loans. Certainly, bank loans are more accessible for big players for a number of reasons. First of all, for a big business, it is easier for the bank to find collateral for the loan. They simply have more assets, right? And those assets could be collateral for the bank loan. Secondly, big companies are usually older. I mean, growing, becoming big takes usually time. So when a big business applies for a bank loan, it's got already some history that shows that this is a viable business. They can produce profit, they can survive on the market. For small businesses, this is more complicated, right? Some businesses would be small because they are simply young and they didn't have time to grow yet. But then they do not have such a history. Some small businesses are old, but they are old and they didn't grow, which means that perhaps their business model is not as good as it could be, right? So it's better to be big here than a small one, because if you are small, then it means you're either young and you're small because you're young, or you are small and you are not young anymore as a business, which means then you don't grow much, right? So you're not a very good partner for the bank. And the last thing, obviously, profits. Okay, the scale of profits. For big businesses, those profits are bigger, so they can actually repay those loans with a greater ease. The second factor that we should take into account is the lower cost of credit for big business rather than for small one. This is for a number of reasons again. Two most important are, first, if you are a big player, then you can negotiate more with your bank. You know, if you come to the bank and you say, I want to take a loan of $20,000, then your negotiation position is very small because you are a small customer. If you come and say, I want a bank loan for $200 million, that's a different story. Okay? You are a big business, and in this way, you may be a very valuable partner for your bank. Secondly, it is more profitable or beneficial for the bank to make one big loan rather than hundreds of smaller loans. Each and every one of those small customers have to be screened with respect to their credibility, whether they could be able to pay back the loan. Okay, so this is 100 screening operations, or just one screening operation for a big company. Right, so that makes it easier for the bank and hence the lower cost of credit. And the last point here would be the question of availability of various sources of financing. So there are venture capitals, there are bonds that can be issued, right? Commercial bonds. You can go to the stock market, making initial public offering, IPO. Okay? Those possibilities are open for bigger businesses. Even for venture capital, this is rarely that it is a micro business, like 2-3 people, and they get funding from venture capitalists. That's very unlikely, right? Venture capitalists would rather invest their money in a business that has a certain size. Okay, size. So, venture capitals, bonds, IPOs, etc. All those sources of finance are more available for bigger rather than smaller businesses. How about diseconomies of scale? There are actually two major sources for diseconomies of scale. The first source is managerial. So there are managerial diseconomies of scale. When you run a business and you employ 5 people, then you may control pretty well to what extent they work, they are active, they are engaged, because there are just 5 people here. When you run a business of 5,000 people, the level of control exerted by managers is clearly lower. So this reminds me of this famous anecdote when the CEO of Hewlett-Packard was asked how many people are working in his company. And he said, well, I'm not 100% sure, but I believe it's half of them. Now, which suggests that he knew that his powers as the CEO of this big company is actually not enough to make all employed people work and perform in a decent way. And obviously, all the management studies, including international management here, are aimed at eliminating or reducing those diseconomies of scale. So management is about how to manage businesses even if they grow without losing this efficiency here, right? So this is about preventing diseconomies of scale. And there are geographical diseconomies of scale. So when you want to operate on a huge area that may become so costly that you cannot actually efficiently produce. So this is like sugar production factories, for instance, right? So they collect sugar beetroot from a certain area, right? But we cannot make one huge central factory producing sugar for the whole, let's say, European Union, right? Because that would be inefficient, right? To make transportation of those sugar beetroots from distant countries to one central point. So these are geographical diseconomies of scale. But here again, this is logistics that tries to deal with that, right? And as you can see, courier parcels, those package dispensers that are in Poland called paczkomat, well, they are both aimed actually at dealing with these economies of scale. I mean, it's not very complicated, costly, or difficult to order a tiny thing like a mug for your coffee from some other city in Poland, let's say, right? So the cost of delivery is really cheap. So logistics is about minimizing, reducing these economies of scale. That's why actually we can have China as the major manufacturer of many goods, because we are pretty good at transporting them from China worldwide.